Thank you so much for joining us for this episode of Leading Change. My name is Emma, and I've got Jamie with me. And I'm excited because we get to team up for an interview of a conversation that we've now had, I think, 3 different times, but we've never recorded it for our own purposes. So I'm excited to have you here this time around. And we're going to be talking about a little bit of the paradigm shift that has to happen within the insurance industry as we start exploring Gen AI and all the rest of the things that we hear in buzz all the time. But before I get to the questions that I've got for you, Jamie, can you give everybody an introduction?
Sure. My name's Jamie Warner, and my background is primarily in data science. So all my education is in math, applied stats, things like that. I also teach those courses at Northeastern University, and I work for a carrier in the space of data science, data enablement, and things like cloud migrations. So I really love this space. I'm super excited about it. And I love thinking about the ways that really restricted industries like insurance can adopt and use technology to make ourselves more successful and to make our insureds more comfortable, more resilient, and have a better experience, typically on the worst day so we can make them whole.
Well, I'm excited. And I want to get us started by maybe not talking about technology, but like a little bit of a history lesson, so to speak. When we start to look at like what is the purpose or the function of rating within insurance and how does that kind of play into this topic of conversation?
Sure. It's a great question, and it's a really good place to start because I think sometimes people forget that the whole purpose of rating is to discriminate risk, and not discriminate in the way we typically think of it, where it has that negative connotation, but actually to discriminate in the sense of to put different groups in different buckets so that we understand the risk, we understand how much it costs to price the risk, and then we can effectively price it, hold reserves for it, and really make sure that we have the right amount of money saved to be able to pay out claims or to be able to support the business. And so it's really important for us to be able to discriminate between different types of risks across the spectrum so that we can hold proper reserves, negotiate treaties with reinsurers, or work through the claims process. So just right price, right person, or risk, right time is how I like to think about discriminating against risks.
So then when we take a look at like how technology is starting to come into this, and especially when we start talking about like AI, there's probably some people that like their heckles are like immediately going up that we're using AI and discrimination and all of these terms together because they're all so tangled. But there's a discussion of like how does technology change this paradigm of rating and what are the types of things that we need to be thinking about as we rely on technology more and more as a part of our rating process?
Sure. So the thing I love to remember to start is that we're not starting from some perfect area, right? We're starting from bias. We're starting from our historic bias. A lot of that might be like a particular person that's in underwriting or a particular person that's in claims or a particular actuarial view. And we're also starting with, models or assumptions to begin with, but those assumptions might not be based on the actual risk. A lot of times they'll be based on something like gender or age or mileage. And the more that we can get more data and information into that, the more that we're actually rating you on the risk that you present versus the characteristics of the person that has the risk. So if I think about like the auto industry, historically, you might have thought about the actuarial tables and they might have had gender and age and a couple of other features, right? And now, as we can collect things like telematics, we can add in information like, do you hard stop? Right? Or do you turn really aggressively? Or how many miles do you drive each year or each month? And those are really much more predictive of risk, and they're tied directly to the actual risks we're trying to face versus just those characteristics about you as a person that put you in a general class. So technology gives us that information to, going back to that discriminate piece, better discriminate against our risks, not necessarily discriminate with obviously protected classes. So when we think about that, we think about a lot more data. We also think about a lot more processing power and a lot more speed. So unlike historically, if you think even about a decade ago, if you wanted to collect information about someone, you might have to ask them for it. You might have to go do like a survey. You might have to regularly connect with them. And you also wouldn't really have a good way to store or process that information. And today, you can have that automatically loading right from your customer from their phone, from different apps, from different wearables immediately, and then immediately turn around and use that information to adjust rates. We've seen some startups do that. Or to make changes in the way that you think about them as a risk. And so that's really exciting. And people think that that's new, but it's actually not that new. As early as the 80s, this sort of telematics work was happening with trucking and commercial auto. So a lot of these things that we think of as new advancements have been around for a while. We just haven't had that combination of processing power, cheap storage, and ways of streaming and manipulating and analyzing data that we have today. And then the final piece is really thinking about some of those predictive models that we can build. And that can give us a lot of information to really quickly make decisions. So I think one of the things that's really exciting about technology is not only can we price the risk and help you really quickly when a claim or an accident happens, but we can also help you really think about how to be resilient, how to prevent losses. We can see those trends really quickly. We can see accidents as they're happening. So a great example of this would be all of these different technologies. And I'm sure, Emma, you saw a bunch of them at ITC this past week, but all these different technologies doing photos, right? Photos from above. And those sorts of technologies, if we think about the drone images, we can actually send in drone images really early on during a catastrophe, for example, and get images of how the catastrophe is evolving, decide where to send people for assistance, decide where to set up different types of things to help. So it just allows the speed um, of both understanding the risk in the early side and then dealing with the risk on the outset, really to change with technology. So that's pretty exciting.
I think it's really, I mean, I'm glad you brought it up because so much of technology, we feel like it happens overnight.
Mhm.
But in reality, what you were saying is like, no, there's like all of these different pieces that have to come together and be perfectly orchestrated for us to then be able to like mass adopt the telematics for insights into auto claims and all of the rest of it. And so I think that that's like a really good thing to put into perspective is that we're not like, even though we're on the cutting edge and it's emerging, it's not as brand spanking new as everybody feels like it is. I mean, even you look at AI, you can make the argument it goes back into the 60s and not in
Absolutely.
the
A lot of those
capacity of
models are
like
from the 60s.
Siri over there who is listening when I said something that kind of sounded like her name earlier, but like it has been here and it's been growing and changing. And now we're just kind of starting to see that like perfect alignment of all of those characteristics coming together to make it something that we can bring to scale. So I really love that. But I also want to kind of like end our conversation. And I think you've been very optimistic and like the way that you've been talking through this, but there is some skepticism that's associated with bringing technology in. And when we were on our panel a couple of months ago talking about ChatGPT, we were like sharing the news of hallucinations with people. And like, there's all these things, and especially the media will make this stuff kind of scary. But can you just kind of like end our conversation talking through like why you're optimistic about technology really coming in and kind of shifting that paradigm for us within the industry?
Sure. And I think it's such a great question because I think it's easy to think about all the risks of adding without thinking of the risks of not adding. And so I go back to that first question we talked about, right? What's the purpose of rating and insurance? And I really feel like the purpose of rating is to give people the right price, right? So that we can effectively protect them. And help them be resilient in the face of loss. And the more that we can do that from true data about that risk, the better that that answer is going to be. And that will make us just generally more effective. It also allows us to understand the biases that are in the system. So a lot of this is built on data. So the thing that we have to be the most concerned about isn't necessarily the models, which I think is a really common misconception. It's the data the models are built on because they're going to repeat any biases in the data. So, one of the things that allows us to see when we have that data and can analyze it is the existing bias. So, we can actually analyze that and then make changes based on that information that really allow us to kind of evolve our thinking, understand the baseline, understand where we're making decisions that could be optimized. But the most important thing to me that makes me feel really optimistic is the fact that we can kind of change the outcome here. right? So by using these predictive models and these technologies, we can do everything from catching fraud more quickly to kind of prevent that from having an effect all across our book, to actually notifying an insured potentially that they might have a threat in their home, whether it's criminal or fire or water shutoff, or in an auto case, maybe we are able to notify you of something that's wrong with your vehicle. Or in a health case, we've seen a lot of health resilience. In fact, I think just last week, Mass Mutual brought out kind of a vitality living program to try to have early intervention, to prevent some of these, early life insurance claim situations. So we've seen a lot of places where this data not only helps us really effectively price and take action when losses happen, but actually create a system of resilience for the industry, which is good for insurers, but more importantly, it's good for the insureds, right? We can make sure that they don't have those situations that we're looking at, which is really critical. So I'm really excited about our ability to use all this technology to create insured resilience.
Thank you so much for joining me for the conversation, Jamie. If you're not already, make sure you make your way over to give her a follow on LinkedIn so you can stay up to date with where she's speaking. And I know you're getting more into that, and I love seeing and listening to you talk about all of this because, for as much as I love technology, I do not have the data science background that you do. So I always love kind of hearing your perspective on things. But thank you again for joining me, and thank you, everybody, for watching, and have a wonderful day.
Thank you.
Thank you so much for joining me for this episode of Leading Change. If you liked what you saw, be sure to subscribe and come back weekly for more expert interviews on digital transformation, change management, and emerging technologies.